Japan tightens rates while printing money. Is the yen on a countdown to 160? Japan has raised interest rates to their highest level in 30 years. In theory, the currency should strengthen, yet the yen plunged instead, sliding straight toward 158. This isn't just a case of buy the rumor, sell the news. Rather, the market has seen through a key card in the Bank of Japan's hand. Hello everyone, this is Ultima Markets. This Monday, the Bank of Japan released the summary of opinions from its December monetary policy meeting. This document is actually the most important window for observing the BoJ's next move. Market focus has already shifted. The question is no longer whether the BoJ will raise rates, but how fast it will do so, and how policymakers view the so-called neutral interest rate. BoJ Governor Kazuo Ueda previously made a very telling remark. He said that the current 0.75% policy rate is still far from reaching the lower bound of neutral. In plain terms, that means there is still plenty of room to hike rates if conditions allow. If the latest meeting minutes reveal such a hawkish consensus, it could be a lifeline for the shaky yen. But here's the puzzle. If the willingness to hike is so strong, why did the yen fall 1.45% after the December decision instead of rising? At Ultima Markets, we break this down into 3 layers. First, buy the rumor, sell the news. Ahead of the meeting, market pricing showed a 93% probability of a rate hike. In other words, the good rumors were fully priced in. Once the decision was confirmed, funds that had been long the yen took profits, triggering a pullback, a very common market phenomenon. Second, policy conflict. On one side, the central bank is tightening monetary policy by hiking rates. On the other, the Japanese government is loosening fiscal policy by pumping money into the economy. Just before the rate hike, the cabinet approved a massive 18.3 trillion yen stimulus package. It's like stepping on the brake and the gas at the same time. Fiscal easing fuels inflation and directly dilutes the impact of rate hikes. Third, and most importantly, the real interest rate trap. Many people focus only on the 0.75% nominal rate and assume it's already high. But in economics, what really drives exchange rates is the real interest rate, nominal rates minus inflation expectations. Japan's inflation expectations currently sit around 2.5% to 3%. That means even with a 0.75% rate, Japan's real interest rate is still negative, at roughly minus 2%. In real terms, money held in Japan is still losing purchasing power. By contrast, even though the US is cutting rates, its real interest rate remains positive at about 1.39%. This nearly 3.5 percentage point real yield gap is the fundamental force suppressing the yen. Unless the Bank of Japan takes much more decisive action to correct this negative real rate environment, the market will continue to vote with its feet. At this point, a break below 160 for the yen may only be a matter of time. Unless Japan's Ministry of Finance steps in again with a surprise year-end intervention. This is Ultima Markets, helping you see through the logic behind major financial events. See you next week.